over the past week. In today's report, we intend to lay out the main fundamental challenges ahead for the precious metal, including the negative correlation of the dollar with gold's price, as well as the release of the U.S. employment report for August last Friday, and at the end, the upcoming release of the U.S. CPI rates on Wednesday. We will be concluding this report with a technical analysis of gold's daily chart. The negative correlation of the dollar with gold's price seems to have been inactive in the past week. It's characteristic that the dollar was on the rise against its counterparts, yet gold's price did not fall. It should be also noted that gold's price rose as U.S. bonds yields were on the decline during the same period. Both short-term and long-term yields were on their decline, with investors potentially expecting an increase of gold's price given the antagonistic relationship between the two finance instruments. For the time being, we see the resumption of the negative correlation between gold and bonds to be maintained for now. We would like to highlight last Friday's release of the U.S. employment report for August, which seems to have created ripple effects beyond the FX markets, influencing both U.S. stock markets and gold prices. The non-farm payroll figure was expected to rise and reach 160K, yet came in lower at 142K. Moreover, last month's non-farm payroll figure was revised lower to 89K, which may have sparked worries about the true resiliency of the U.S. labor market. Yet the unemployment rate ticked down to 4.2% as it was expected, which was lower than last month's rate of 4.3%, and that may have mitigated the negative impact on the dollar. Overall, the data implied some loosening in the labor market, yet the confirmation of the unemployment rate coming in at 4.2% appears to have reduced the market's expectations of a 50 basis point cut by the Fed in their next meeting. In turn, this may have aided the dollar, which appears to have temporarily weighed on the precious metal given the inverse relationship between the two. The next big test for gold traders may be the release of the U.S. CPI rates for August, which are set to be released on Wednesday. In particular, the U.S. headline CPI rate for August is set to showcase easing inflationary pressures in the U.S. economy, with the rate expected to come in at 2.6%, which would be lower than the previous rate of 2.9%. Thus, should the headline CPI rate come in as expected, it may imply that the Fed's 2% inflation target is coming better into view, and thus could increase pressure on the bank to ease its currently tight monetary policy stance in their next meeting. In turn, the implications of inflationary pressures easing in the U.S. economy might weigh on the greenback while providing support for gold's price given the two's inverse relationship. However, should the headline CPI rate come in higher than expected and thus imply persistent or even an acceleration of inflationary pressures, it may increase pressure on the Fed to maintain a relatively restrictive monetary policy stance, which could have the opposite effect on gold's price. From a technical perspective, gold's price has continued to stabilize over the past week, just below the 2,520 resistance line. We opt for a sideways bias for the precious metals price, and supporting our case is the RSI indicator below our chart, which currently registers a figure near 50, implying a neutral market sentiment. Moreover, we would like to note the sideways moving channel, which was incepted on the 22nd of August. For our sideways bias to continue, we would require the precious metals price to remain confined between the sideways moving channel defined by the 2,470 support line and the 2,520 resistance level. On the flip side, for a bullish outlook, we would require a clear break above the 2,520 resistance line, with the next possible target for the bulls being the 2,570 resistance level. Lastly, for a bearish outlook, we would require a clear break below the 2,470 support line, with the next possible target for the bears being the 2,410 support level. Thank you for being with us for today's financial update. From all of us here at IronFX, we wish you